The artificial intelligence bubble just popped, and nobody wants to admit it. While everyone's been obsessing over when AI would take over the world, the market just delivered a brutal reality check that's about to reshape everything we thought we knew about the future of technology investing. Right now, as I'm recording this video on November 20th, we're witnessing something that financial historians will mark as a turning point. The so-called Magnificent Seven. Tech stocks, the companies that have carried the entire market on their backs for the past 2 years, are crashing back to earth. And the reason why should terrify every investor who bought into the AI hype. Here's what happened yesterday. The S&P 500 just notched its fourth straight losing day, marking the longest slide since August. But that's just the surface. Dig deeper and you'll find that Amazon and Nvidia, two of the biggest AI darlings, have officially entered correction territory with drops of more than 10% from their recent highs. Tesla's already there, and Meta is in full bear market mode. The Wall Street Journal is calling it AI bubble fears. But here's what they're not telling you. This isn't fear. This is reality finally catching up with fantasy. For months, we've been told that AI would revolutionize everything overnight. Companies slapped AI powered on every product announcement. Investors threw money at anything with artificial intelligence in the pitch deck. The market cap of these 7 companies swelled to represent nearly 30% of the entire S&P 500. Think about that. 7 companies out of 500 controlling almost a third of America's stock market value. But now the emperor has no clothes. And the market is finally asking the question that should have been asked 2 years ago. What is the money? See, here's the dirty secret about the AI revolution that nobody in Silicon Valley wants to discuss. Building AI infrastructure costs an astronomical amount of money, but monetizing it, that's proving to be the trillion-dollar problem. Nvidia spent billions developing chips that can train AI models. Amazon poured resources into AI services. Meta bet the entire company on an AI-driven metaverse future. But when you look at the actual revenue generated specifically from AI products, not just revenue growth that companies attribute to AI, the numbers don't justify the valuations. And investors are starting to notice. When Nvidia reports earnings, which everyone's watching like hawks, the real question isn't whether they beat expectations. It's whether they can prove that AI demand is sustainable, not just temporary gold rush. Here's where it gets really interesting. This correction isn't happening in isolation. We're seeing a broader rotation away from growth stocks and toward value. Why? Because the Federal Reserve's interest rate environment is making investors ask harder questions about profitability. When money was basically free, you could justify investing in companies based on their potential. Now that borrowing costs matter again, investors want to see actual returns. But there's a deeper story here that connects to something much bigger than just stock prices. This AI bubble burst is exposing a fundamental flaw in how we think about technological disruption. We become addicted to the idea that every new technology will create exponential returns immediately. We saw it with the dot-com boom, we saw it with social media stocks, and now we're seeing it with AI. The reality is that transformative technologies take decades to fully mature and generate sustainable profits. The internet didn't make most companies rich overnight. It took years of infrastructure building, business model experimentation, and market education. AI will be the same way. And here's what's really fascinating. While the AI stocks are crashing, the actual AI technology is still advancing at breakneck speed. This disconnect between market performance and technological progress is creating one of the most interesting investment environments we've seen in years. Smart money is starting to look beyond the obvious AI plays. Instead of betting on the companies building AI infrastructure, they're looking for companies that will benefit from AI adoption without having to spend billions developing the technology themselves. Think about industries like healthcare, logistics, or financial services, sectors that can implement AI solutions to cut costs and increase efficiency without having to invent the underlying technology. The correction in these Magnificent Seven stocks is also revealing something crucial about market concentration risk. When seven companies control 30% of the market, their problems become everyone else's problems. Your retirement account, your index funds, your pension, they're all heavily weighted toward these same companies. This concentration made everyone feel like geniuses when AI stocks were soaring, but now it's amplifying losses across the entire market. And let's talk about what this means for the broader economy. These tech companies have been massive employers, especially in high-paying engineering and research roles. If they start pulling back on hiring or worse, implementing layoffs to preserve margins, that ripples through the entire economy. These are the workers who buy expensive houses, luxury cars, and drive consumer spending in major metropolitan areas. The timing of this correction is also worth noting. We're heading into 2026, which means we're approaching the typical peak of the business cycle. If AI stocks, which were supposed to be recession-proof because of their revolutionary technology, are struggling now, what happens when we hit a real economic downturn? But here's the contrarian take that I think most analysts are missing. This correction might be exactly what the AI industry needed. The easy money and sky-high valuations were actually preventing real innovation. When companies can raise unlimited capital based on PowerPoint presentations, they don't have to focus on building sustainable businesses. Now, with capital becoming scarce and investors demanding results, we're going to see which AI companies actually have viable business models and which ones were just riding the hype wave. The companies that survive this correction will emerge stronger, leaner, and more focused. They'll be the ones that actually deliver on the promise of AI, not through flashy demos and marketing campaigns, but through products that solve real problems and generate real profits. This is also creating opportunities for smaller, more nimble companies that could not compete with the Magnificent Seven when money was flowing freely. Now that investors are being more selective, innovative companies with solid fundamentals have a chance to get noticed. So, what does this all mean for you? If you're an investor, This correction is a reminder that diversification isn't just about spreading your money across different stocks. It's about not getting caught up in whatever narrative Wall Street is selling. If you're an entrepreneur, this is your moment to build something real while everyone else is distracted by the falling stock prices. And if you're just trying to understand where the economy is heading, this AI bubble burst is a preview of what happens when reality meets hype. The question isn't whether AI will transform our world. It will. The question is whether investors have learned anything from the countless bubbles that came before, or whether we're doomed to repeat the same cycle of irrational exuberance followed by inevitable correction. What do you think? Is this AI correction a healthy reset that will lead to more sustainable growth? Or are we watching the beginning of a broader tech crash that will take years to recover from? Post answers, comments, and I'll see you next time. Bye-bye.